this video we're going to have a look at Stophunts and how to trade them. Now the question is, are you trading the market or is the market trading you? I can't stress how important patience is in trading, and impatience plays right into the market's hands will only lose you money. So if there's only one piece of advice you take away from this video, it's let the market come to you. Now this advice makes a lot more sense in the context of Stophunts. We wait for the weak hands to get shaken out and we participate with the smart money. Let's take a look at some charts and you'll see exactly what I mean. Okay, here's a Euro USD chart. It's a 4-hour chart and it's a great example of the market hunting stops in order to reverse. So you can see the major highs and lows were stop hunted by very quick spikes. So there'll be stops below the swing low and they're quickly spiked out before the market reverses, and there's stops above the swing high, and again the market spikes out the stops and then quickly reverses. There's also some minor levels that I've drawn in here, so you can see this one here where there's a quick spike and a reverse, and there was another one here, a quick spike and reverse again. What should the stop hunt look like? Well, it's either going to look like a V shape like this, so a V return, or it's going to be a very quick spike and return just like that. So that's ideally what we're looking for. Now, as we saw in the previous video, this is another common trick the market really likes to play. Builds a range and accumulates traders' stop losses either side, and then it whipsaws both sides of the range and takes those stops. So in this example on the 1-hour Euro, traders who bought inside the range are stopped out, and then traders who sold the range are stopped out too. And generally, the last traders to get stopped out, those who sold in this case, see the market go in their intended direction without them. Here's another common scenario which reminds me a bit of the casino. You know, when the croupier clears the roulette table of all those chips because everyone's lost. Well, this is what happens before key news events such as FOMC or non-farm payroll. The market reaches deep into liquidity, clears those stop losses and then reverses, leaving a very large spike behind. And this is what I call wiping the board of stops. So you could have been sitting in that range and been long and been totally right on the direction, and you still would have had your stop loss taken out. The answer is either to buy at demand or wait for the stop hunt before entering long. Here's a FTSE 1-hour chart. Notice how the market spikes the prior high into resistance before quickly reversing. It takes out all the stop losses. But there's also something else about this chart too. If we go to a 4-hour chart, you can see this supply zone, and you could have sold supply. So once you've seen the stop losses taken out and the market has spiked into supply, you could have sold it and then profited. So by now you should be getting a good example of how you can trade with the smart money rather than being caught with all the retail traders, and I hope a few light bulbs will come on for you here. Okay, now this slide is entitled GBPUSD and why the technicals beat the fundamentals. The pound-dollar pair, otherwise known as cable, loves to spike stops, it loves to play tricks. And on this weekly timeframe chart, there's 3 examples of stop hunt, so let's have a look. Okay, so first you had a stop hunt here of the range, and then the market immediately reversed, and as it did that, it left a supply zone behind it. We then had a stop hunt of a prior high into supply, and the market reversed again. And then finally, we got this major stop hunt of a major swing low, and the market very quickly reversed. Now, let's actually see what happened in the news around the time of those stop hunts. On June the 20th, 2016, CNN said the pound was surging, and that, if you were just following the news, that may have got you to buy the pound. Then 4 days later, on June the 24th, the UK voted to leave Europe, and the pound reversed. Now, if you'd just seen the stop hunt and the reverse, it would have made complete sense to you, and you wouldn't have been caught out by conflicting news headlines. Now, fast forward to the 23rd of March 2020, and just as Boris Johnson plunges the UK into lockdown because of COVID, the pound spikes a low and starts a major rally. Now, as a fundamental trader, you may have been thinking that that was really bad for the pound, but looking at the technical position here, the market had taken out stop losses on that news. It had made 2 wicks and then it reversed. So just trading the technicals can sometimes make things look clearer than if you were to follow the news, which is often wrong. Here's one final slide to show that financial news media really doesn't have your best interests at heart. So on January the 8th, 2018, CNBC host Brian Kelly gave a crypto class live on TV showing how to buy the cryptocurrency Ripple. The price at the time was $2.57, and the next day Ripple started its descent back to 0.11. So CNBC had instructed their viewers to buy right at the top of the market. Was this a bad call or media manipulation? I'll leave it to you to decide. You'll be pleased to know I've got a lot more to teach you, and I cover it all in my courses Professional Trading with Institutional Supply and Demand and Advanced Price Action and Market Structure. You'll learn exactly what makes a good supply-demand zone, advanced supply and demand trading strategies, the filters to stay out of bad trades, and how to predict changes in market direction. I'll teach you the exact methods I use to make some of those spectacular trading calls on Twitter, and you'll be able to use that knowledge to trade similar setups for yourself. So that's it for now. I hope you've learnt something from these videos. I've got a lot more to teach you, and I look forward to seeing you in the future.